All right. Good morning, everybody. So the banks have kicked off earnings. Um, the ones that were doing really good continue to do really good, and that's where we're at. Some of them came in a little light, and they're talking about how the banks could be the other leg of this AI extravaganza push, but they need to fulfill their obligations. So we'll see. I believe that we've finally had a fundamental shift. We've been in this regime where we could not go down, and every time the market tried to go down, it was just bid right back up again and up again and up again. But now we've finally crossed that line, and there has started to see a sea change. This might only last through October. We got the shenanigans that happen during this time of the year every year. So we'll see. We need earnings to unfold more. And some of what I'm reading at this point can very well just be participants waiting on that earnings. We are red around the world. Small caps down the most, 1.25, and Hong Kong doing the best, basically flat. It keeps fluctuating above and below zero. Japan's doing surprisingly well, only down 1/4. So everything's red, and we still have a lack of data. We got, the government still shut down. It's not a surprise. Lots of Fed speakers, which, they don't have anything to contribute, nothing new to contribute, I guess would be a more accurate thing to say. Some auctions today in the front end, 3-month and 6-month. Powell's speech. I didn't think this was anything in particular. I'll dig into this. If it's just some pre-recorded message, or if there's not going to be any Q&A, then it won't have any real impact, right? If they're going to question him, then we want to be really mindful of this event, because gotcha questions being taken out of context, there's all kinds of ways that interviews can go wrong. But other than that, should be just nothing. So I'll circle back on that. If you don't hear from me by the open, hit me up. I'm easily distracted. Ooh, squirrel. And then, I forget. It's not it's not Alzheimer's. I'm not that old. All right. So unlike yesterday where we had a whole lot of green that just wasn't up enough, this morning we barely have any green at all. And the ones that we have, they're above the line in the sand. Kind of a messy chart, but I have this line in the sand from David Keller at stockcharts.com. I don't know if you guys have ever really gone over there and hung out, but he's a really smart dude, and he's interviewed really smart people over the years. And David Keller has these lines on the VIX that when I heard him talking about it, I thought, well, that was just so simple and so basic that I love it. And I took them and put them on my chart, and they've been there ever since. So if we are below $20, then when the market is moving around and we see a little weakness, it's just a pullback. That's generally the S&P pulling back 3 to 5%, sort of those buy the dip swings that we all really love to get. And then if the VIX gets above $20, then we're more into that correction territory and we have the expectation of a deeper pullback. Now, obviously, you got to put that into perspective. If we just wick up and drop back down in one day, then who cares, right? Like, there's always nuances to all of this, but it's it's a line in the sand to be mindful of. And once we are above it, as long as we continue to remain above it, then we're going to continue to see the S&P and the NASDAQ struggle to perform. So, for those who don't like getting into dealer gamma and GEX and all that complicated stuff, this is just a real handy way to play the game. We are above the 20. Swag levels now line out at around 23. If we chop or stay between 23 and 20, it shouldn't get any worse out there. Probably bounce, hold the line, maintain range and structure. Should we get above 23, I would expect a new leg lower. Yesterday's metals and mining and uranium continued to perform well, and quantum. And then, of course, as I mentioned, those banks, JP Morgan, Wells Fargo, Citi, Goldman, BlackRock, and then off to the side, Johnson & Johnson. We are below the zero gamma line. We are below the put wall. I shared the image that the put wall rolled up. The call wall stayed flat. And we got the volatility trigger at 67.17. I don't know if you guys were trading at this morning, but the run back to VWAP has been good. At some point, we might cross over VWAP, and I would be looking for reciprocation plays. I know it's a big, fancy word, but don't let it confuse you. This is a 0.5%, 0.53. Just look for a 0.5% move on the other side. That would get us into 66.75. That's reciprocation. Think of a jigsaw, right? When you're running a reciprocating saw or a jigsaw, it only moves X amount in one direction and then X amount in the other direction. So when we get a crossover, which we will eventually get a crossover, I would look for that same distance to be matched on the other side. Of course, we're still inside of this really big bar. That's my Captain Obvious moment for the day. And so far today, we've developed an outside bar off of yesterday. So this is just a real ugly, complex topping pattern right now. The big drop down was a bit extreme, a little more violent than I think the market was ready for, but we're holding above that 50-period daily moving average. The problem with the move in its violence was how it dragged the moving averages down. We got a surge signal. That's when the 3 and the 10 cross. So price crossed the 3, it crossed the 10 and the 20 and the 50, but it dragged that 3 across the 10. What we're getting ready to see is a 10-20 cross. That has more weight behind it, got bigger implications. Now, we're not talking about trade triggers here, tradable opportunities. We're just talking about technical analysis and performing technical analysis. getting a 10-20 cross has longer term implications. And whether or not it stays crossed becomes a really big deal too. So, one of the things that you can do if you want to understand all of that better is find places where the 10 and the 20 crossed before, like back here, for an example. The move down wasn't as dramatic in that first candle, but we made an extended move to the downside through February and into March, and we dragged the 310 cross and then the 10-20 cross, and then of course we got all three of those underneath the 50, and we eventually got underneath the 200, and down it went. Now we've got a lot of work to do before we even think about looking at the 200 period moving average, and price would need to get below 50 if we're going to see the moving averages get below 50. But that's why this is just a topping pattern, and it's not a downturn like this. This didn't top. It didn't put in this move. The topping was back here. So we got to see how all of this shakes out. We're missing a lot, by the way, right? If you want to understand all of that, we need a lower high and we need a lower low. And right now we don't have either one of those. We just have this low. We don't know how this is going to pan out. If we say rally back up today, then this red candle won't even exist. It'll just be a long wick, and we'll have some close up here somewhere. If we continue to fall and we move lower, then we could count this as a lower high. But at the moment, we can't count it as anything. So all we have is this low. There's so much more we need to have other than just that low. So yesterday we saw extended overnight trading volume at 180. That was more than double the average that we had been seeing. In some cases, it was triple, right? Now we're at 217,000. Now this doesn't read all night long. I set it to where it's starting at midnight and it's counting how much volume did we get since midnight. It's basically just capturing Europe. And I was using this long ago trying to gauge the amount of participation in the overnight hours. The numbers don't mean anything if you've never seen it before. And just looking at it every day over the last few years, I've kind of got a feel for what normal looks like. And then, of course, I added the numbers to where you can see them. That way you don't have to guess, well, what was yesterday or what was last week? We haven't seen a 200 number in quite a long time. So we have a significant participation. With the breadth structure that we saw yesterday, it makes sense that we're seeing significant deleveraging and a capital rotation that hasn't shown its hand yet in the broader markets. But under the surface, there's a lot headed to the downside. And this shows a lot of market participation. If they get that much work done in the pre-market, how much left do you think they have to do in the intraday? Take yesterday for an example. Once we actually got into the trading day, we didn't get much done afterwards, right? Because if you stop thinking about it as traders coming in here and speculating on whether or not it's going to go up and down, that's what you and I do, right? That's retail traders. We're just trying to make money on its movement, speculating on what direction it's going to go. But there are very large funds and firms who are trading this for payroll or so they can buy coffee or whatever it is that they've got to do, pay for shipping on some product, hedge things, you know. They don't have any interest in whether or not it's going up or down. They're just performing their duties. And if, Joanne gets the call and says, I need you to pick up 20,000 contracts today, then she's going to work on picking up those 20,000 contracts today. Once she gets her work done, she's done. She doesn't have any reason to come back in the intraday. She's not speculating and swing in trading. So I see that number and I begin asking questions like, well, who's left to trade today? Who's left to come in here and get any work done if they've already done it all last night? I know it's easy to just imagine that everybody's trading because that's what we're doing, but that's not what everybody else is doing. Just like yesterday, we've already reached the full ADR. We had a nice bounce off of that if you were awake to play it. We got down into 66.11 and now we're working our way back up into 66.50. It's very likely we'll find the bottom of the ADR half again. It seems like we're due. So I haven't seen this in a while, but what's really cool is you can go from one side all the way to the other side by the end of the day. Sounds wild, I know, but you can actually do it like that by the end of the day. We've seen that, right? You can go from the bottom to the top, back to the bottom, or vice versa, top, bottom, top. It's a wild day, but it would not surprise me if we are above 67.25 at some point today and challenging this 67.60 level up here. I would not be surprised at all. The ADR is just a little bit bigger than yesterday. By memory, I think it was 64. Now it's 68. We're going to continue to see that expand. Maybe I'm misremembering. It seemed like it was 64. This is also forming out like a TRB, and a TRB would owe us back to the 67.11 at least, the cog line up there. If we expand lower than our own Globex low, I think the 65.50 is a very nice target to start with. And then let's expand through the low that's been here, 65.32 cog line, and get into 6,500. Then we'll see what's up from there. Remember, a 2% move is nothing for the S&P. It's an easy day, walk in the park. But I think it's time for a rebound, just to shake things loose. And I'm not thinking that we can get up into the 92 cog line all the way up here, or even, back up into these previous levels. I'm not looking for that. I'm just looking to kind of solidify this pattern that we have here. If we can get a cleaner high into 25 or 67.50, right, then it would have a better technical analysis pattern on that rollover. So we'll see. Otherwise, we're going to look to break this low and get down into 65 or 64.50. Good times. Today's floor pivot is higher than yesterday. That's considered bullish. Price opened above it. That's also considered bullish. But then we waterfall crashed through it, and there's nothing bullish about that. It's not an MDP since we've already hit it. Obviously, we don't have a missed daily pivot anymore, and we're struggling with the weekly pivot. 65.92 cog line down here is the lower edge of the weekly floor pivot channel. Staying above the weekly continues to put us in that risk on mode. But whether we're risk on or risk off, this is broken and it needs to heal. So let's resolve that by digesting for a few days. Typically speaking, we look to stay long when we're above the weekly, and we look for short opportunities when we're below the weekly. The S&R levels are likely a lot tighter today than they were yesterday, since we had time to digest. Yeah. So we've already made S1, and we did not immediately work on an R2 from that S1. So now that's a line in the sand we got to get through. 66.44. Otherwise, if we can't sustain that, like here when we were unable to sustain it, we fell back down, it puts this lower one back on the table. It's basically 6,600 down there. If we can get above that floor pivot today, get through our own Globex high, we got R1 at 23 and R2 at 57. It's a little bit shunted, but there's perhaps a more classic P shape than last week's. 66.90 as the week's point of control. We're outside the value area. That would be the target for the TRB, is getting back inside of this value area. But it's also where there's expected to be a lot of work to get done. So it'll be difficult to work through this. We don't expect to move through these sorts of zones quickly. When it's thin and shallow, we expect to move through them a lot easier. Get bigger bars, longer legs. It's a weak tail, just like this one back here. Ten-day, 30-minute volume profile in TPO. We started to develop a second distribution, and then we legged out of it, and now we're headed down again. If we try to work our way back up, it's likely we're going to stall out in this zone. It'd be this whole area that we're working on. Now, for each new candle we get on the right, we're going to lose one on the left. And so that means we're going to lose this cluster, and that's going to wipe out some of this volume, especially if we don't get our bum back up here, hang out in that zone. So it's kind of what we want to see. Price crossing back through that 6,700 area, building it out between 66.80 and 67.20. It's a nice 40-point range. If we don't do that, then as we lose this cluster, that volume node's going to dry up. We still have no expectation that this point of control is going to go anywhere anytime soon. And eventually, when it does move, depending on how much volume we have in here, that's very likely where it's going to end up. Because sure, we have this group back here, but we also have this group here. So we're going to lose this in the next 36 hours, and then all we're going to have left is that, unless we can come back up and put some more work in. All right, looking at the 5x5, we still have the VPOC. The point of control from yesterday didn't give us a new VPOC. This morning, we got a discrepancy between the TPO and the point of control. And look at these distribution clusters. So if we do attempt that TRB and work our way back up, having that profile on the screen today would probably really help you out. Normally running an intraday profile is not something I'm necessarily excited about. It's really noisy. It's a lot of garbage on the chart. If you got a lot of screens, it shouldn't be a problem. Otherwise, draw the line out. It's not like you actually need the profile to be there, right? Mark a line out where those levels are at, so that if we try working our way back up, you know where you're going to run into previous work. Watch the dome and the tape as you come up into those levels to see if they're defending each one of those. The idea would be a lot like triggering those stops. I think we've all talked about that before, right? Like the popcorn play or whatever the heck it's called. This would be on just a more granular level. We're still 1% below the 10-day. That's kind of the sweet spot. 1% below, 1% above, and then a half of a percent below and a half above. If we're within that zone, it's within the comfort zone. Margin of safety is not really a word I like, but it fits. Outside of that 1%, things get a little ugly. We can expect, more negativity when you're more than 1% below the 10-day. Kind of like that VIX discussion, especially when you put the two pieces together. When you got the VIX above 20 and you got the S&P below the 10 by more than 1%, things are pretty nasty out there. So far, this gap up on the week has been restrained by that 6,700 level. I mean, sure, we've poked above it a little, but we didn't go anywhere. And one of the overriding concerns at the moment is that half back of this really big bar. Now, sure, you could just get all of last week, right? Just take it a little farther up. That's the half back for the entire week. It didn't really change much, right? Maybe 3 points. 66.76 ish. The line in the sand is the midpoint. As long as we're continuing to close below this level, then we can't expect a recovery. And I would not be trying to add to long positions with that sort of weakness staring at us. We're still not looking at like a 2022 bear market. That's not the kind of backdrop that we're in. But a short-term significant drop to the downside, getting into 65, 64.50, 62 by the time all of this is done, that wouldn't surprise. And especially if it can get done quickly. I mean, not like as quick as we had this drop here. We don't want to scare the world, but the sooner we get this correction completed, the better, and resolve some of these underlying issues, then we can get back to business as normal. Either way, we're not overbought, we're not overextended, we haven't moved too far too fast, and it doesn't owe us any sort of mean reversion, pullback, or least squared method. No dot plot statistics or anything else suggests that we have anything coming to us. The distance between the 10-day and the 10-week is the same. We're 1% away from the 10-week, we're 1% away from the 10-day. So another way to say that is we're still 1% above the mean. The mean is a generic perspective of, quote, fair value. Now, you don't have to at me later saying that it's not fair value. I know it's not, but it's a close proximity of it, and it works for an off the cuff analysis of what fair value would be. So we're still, in that regard, we're still looking at a market that's running hot. I know it may not feel like it, but we're still good. So this morning we've got Bitcoin down, the Mag 7 up volume is down. Let your mind work on that one for a little bit. China is also down, chips, nat gas, China again, bots, tech, quantum, magnificent seven, energy, growth, solar, space, quantum again, consumer discretionary, banks, gold, gold miners, cloud computing. My goodness. Hey, another way to say this is everything is down. Everything's down. The only things that aren't down is a little bit of uranium bonds, the dollar gold ratio, and the VIX. The VIX is up 32.8% in a 5-day period. Gee, is that all? And the Mag 7 down volume is up. You like that one? There are a few markets that aren't up or down, like airlines, a couple others. But for the most part, we've got a deep weakness. One of the things that you can do in the mornings, these are all ETFs, ETNs, and grouped items. It's like a basket of stocks. Every name represents some group or industry or sector, but then you can dial that in a little bit. This is the S&P 100, looking at how many stocks in the S&P 100 are down at least 0.5% or more. So that when you're looking at market breadth, you can try to define, well, how deep is the negativity, or how, we could flip it around, and on a positive day, we could see how positive the market breadth is. And then, as much as nobody likes to hear it, some stocks are worth more than others, not just in their stock price, but in their impact and value within the index that they fit in. Like GameStop or Riot, who the heck cares? Some Joe Schmo gas company. So what? Compare that to something like Meta or Google or Apple, Amazon, Microsoft. They have a much broader impact. So not just how many names are down, but what specific names are down, and by how much, and what sector or industry do they represent. So this morning we got 45. That's pretty heavy for how many names are down at least 0.5%. And since there's 100 names, this number can be converted to a percentage. It's not just 45 names that are down in the S&P 100. It's 45% of the S&P 100 is down this morning, at least 0.5%. And we can see in those groupings, technology services, retail, finance, more tech, And then, of course, we can break it down into the industry, aerospace and defense, packaged software, and then the big ones, semiconductors. You cannot have a rally day when 45% of the S&P is down more than 0.5%, and the names that are in that list are the Mag 7 and big semiconductors, and you're just not going to get a rally day at this point. That can change. All these names have to do is stop falling. They don't necessarily even have to rise, just stop going down, and then 0-day options flow can do the rest. Or they can start to go up, and then we can get assisted by 0-day options flow. Changes in the dollar, changes in the yield, all those could contribute to a change in what we have. But looking at what we actually do have, we got a very negative S&P this morning. And if you can do it for one index, you can do it for another. That was the S&P. Now we've got the NASDAQ. And out of 100 names, 54 names in the NASDAQ are down at least 0.5%. So that also can be converted into a percent. 54% of the NASDAQ this morning is down at least 0.5%. It looks like all of the semiconductors are down, but of course there's usually one outlier somewhere. Packaged software, services. You're not going to get a rally day with this. Not yet. So that's what's got to change. The market breadth. If you don't have TradingView and you're using Thinkorswim, once the market opens, go to the Market Watch tab, choose the Visualize. And I know this isn't really what you're looking for. Change the heat map to the index watch and then choose whatever index you like. They've already got them built. So you can choose the S&P 100 or the NASDAQ 100. And these are detachable, so you can stack them all up. You can get a lot of them. Build one for the Mag 7 because it'll take your own custom personal watch list if you want to do that. And you can scrunch these up nice and tight and see issues, which are companies, how many are advancing, how many are declining, and you can watch their money flow. And that way you can do the same thing that we were just looking at in the intraday with volume and money flow. Just be mindful of the fact that it won't work until we get into the open. And it's just one piece of the puzzle, right? It's just a more advanced decline perspective. You don't want a rally day based on pot stocks or solar, gold. And another gap up. Look at that. It like just defies gravity. I know there's a lot of people who want to short gold because of how far it's moved to the upside, and I get that. I think Tasty Trade did this really deep dive into should you short something that has gone parabolic, and they had some rules for it. It was like the heck was it called? The aggressive contrarian trade strategy is, I believe, what they called it. And I remember Tom Sosnoff going short Apple and Tesla when Tesla was gonna do a stock split. He got run right the hell over. It doesn't mean that it doesn't work, right? It just, you have to have some context into why is it going up in the first place. And it, rules are there, and if it doesn't work, it doesn't work. But I wouldn't try to short this yet. I don't care how much it's run to the upside and how much it looks like it has to go down. This is irrational, right? This move is completely irrational, and markets can stay irrational longer than you can stay solvent. I did not coin that phrase, but it is a true one anyways. I also keep coming back to, you remember when things got really bad, like during COVID and all that, and the banks were getting margin called? And what did they do to cover their margin? They sold their gold. Now, they weren't as leveraged in gold at the time as they are now, and gold didn't have such a margin requirement as it does now. Remember, you don't get to trade leverage like this free forever. The margin required to trade something increases when volatility increases. The margin is on a sliding scale, and you have to pony up more and more margin to trade something that becomes more and more violent. If or when gold does flip, it's going to be a race to the exit to see who can get out of it first. And they'll be hitting below the bid, and it should be a beautiful sight to see. But you can't time that. And it's likely going to be a shock and awe surprise moment. But if all their money is tied up here, they're not getting into anything else. All right, guys. So it's another relatively easy day. Get above VWAP for a chance to get back to the Globex high. That performs a TRB. We have every expectation of digesting this move, staying within this really big bar, which is not a hard call at all, right? That's like a Captain Obvious moment. We're going to stay inside the bar, very likely. The question will be, how big of a range inside that bar are we going to perform within? Staying within yesterday's boundaries for the most part should be the base case argument, the ADR lines that I mentioned at the start of all of this. And that if we begin to expand above or beyond either side, above or below, that it could pick up speed with velocity like we did the other day and make a 2% or more move. Should be relatively easy to do, right? But that's not the base case argument. We made ADR full yesterday, and that's all we did, right? We just stayed at that ADR all day. We could stay at this ADR all day and not do anything. It doesn't owe us anything. So base case, we stay here, we just hang out, or we cross VWAP and we hang out at this upper one. And we go into the close. All right. That's what I got for you guys. Be careful, be safe, keep your eye on the clock. I'll see y'all tomorrow.